Welcome to This Explainer. Today, we're going to unpack a massive financial mystery based on some seriously revealing research. It's all about a strategy you've probably heard a million times, maybe from a well-meaning uncle at a family barbecue. Buy low, sell high. Specifically, we're going to look at what happens when you decide to hold your money in cash and only invest during market crashes. I mean, it sounds incredibly smart, right? Keeping your powder dry until there's blood in the streets? But, well, when you actually run the math behind this strategy, it tells a completely different and, quite frankly, shocking story. Let's get into the data.
To really wrap our heads around this, let's bring it to life and meet two very different investors, Cole and Carol. They're exactly the same age, they have the exact same job, and they both have exactly $300 a month to invest. The only difference? Their mindset. Cole is our classic buy the dip guy. He sits on a pile of cash, neurotically refreshing his phone just waiting for a crash. In his mind, he's being super disciplined. Carol, on the other hand, just automates a $300 transfer into an index fund on the first of every single month. She genuinely doesn't care what the market is doing. Now, on paper, Cole's plan sounds far more intelligent, while Carol seems, dangerously lazy, buying on objectively terrible days just because it happens to be the first of the month. But let's see how this actually plays out in the real world.
Section 1. The flaw in waiting. Time for a bit of a harsh reality check.
Think about this number for a second. 11 years. From March of 2009 all the way to February of 2020, the market climbed for nearly 11 straight years without a single bear market. During that stretch, the market returned around 400%. Picture Cole sitting through that entire decade-plus run with his cash just chilling in a savings account. He's constantly checking his watch list, waiting for a crash that just doesn't come. Every month he thinks he's being patient, which really just means he's doing absolutely nothing while Carol's money is relentlessly compounding in the background.
And this illustrates exactly what Cole is up against. The market is actually positive in about 3 out of every 4 years. That is 75% of the time. Cole isn't just betting on a simple 50-50 coin flip. He's consistently betting against a loaded coin, staking his entire financial future on that tiny 25% sliver over and over and over again.
And it gets worse. Here's a really uncomfortable truth from the data. Since 1950, the S&P 500 has closed at a record high on roughly 7% of all trading days. And here is the absolute kicker. Almost 1/3 of those all-time highs became permanent floors, meaning the market never dropped below that price ever again. So when Cole says he's waiting for a dip, what that usually translates to in practice is that he's waiting for a price he's literally never going to see again.
Which brings us to Section 2, the perfect timing test. What happens if Cole is actually right?
Charles Schwab ran this fascinating study to test exactly this. They looked at 20 years of market history and tracked 3 investors who invested the exact same amount of money every year. One is a perfect, godlike market timer who magically buys on the exact lowest day every single year. Flawless execution. The second is Carol, who just blindly feeds the money in as it arrives. And the third is Cole, keeping his money in cash, waiting for the absolute right moment. Ask yourself right now, who wins this over a 20-year span, and by how much? Because most people assume perfect timing absolutely destroys the competition.
Well, check out the massive gaps in these returns. The perfect timer, the one who magically nailed the exact bottom every year for 2 decades, finishes with $186,000. Carol's completely automated zero-thought approach lands right behind at $166,000. 20 years of literally flawless, godlike timing barely beats a woman on autopilot by about 20 grand. But Cole's cash strategy? $47,000. The patient genius keeping his powder dry finishes with barely a quarter of what Carl made. Incredible.
But wait, here is the truly wild part. That 3x multiplier. Schwab ran one more investor in this test, the unluckiest soul imaginable, who bought at the exact peak, literally the worst possible day every single year. That cosmic disaster of a portfolio still tripled Cole's cash returns. Let that sink in for a moment. Buying at the worst possible moment on purpose beat waiting for the perfect moment by a factor of 3. Being in the market on terrible days was just a rounding error. Not being in the market at all was the real catastrophe.
And if we stretch this out to a 40-year time frame, as finance researcher Nick Maggiulli did, it gets even crazier. He tested dollar cost averaging, which is Carol's strategy, against an omniscient dip buyer who knew exactly where the market bottoms would be. The data shows that the boring monthly investor actually beats the all-knowing god of market timing 70% of the time. But humans aren't gods, right? If you make that perfect timer even slightly human, so they miss the exact bottom by just 2 months, Carol wins 97% of the time. No contest.
So, why on earth does this happen? Well, it comes down to a brutal mathematical truth. While waiting for the perfect moment, your cash earns absolutely nothing, and the market naturally drifts upward. The rare bottoms that Cole is so desperately waiting for, they almost always sit at price levels that are way higher than where he could have just bought years earlier if he hadn't been sitting on his hands in cash.
Moving to Section 3, the cost of being human. Let's look at the psychology behind all this.
There are two major hidden costs to waiting for a crash. First up is the crash delay. Now, 10% corrections happen roughly once a year, sure, but real bear markets, those juicy 20% drops Cole is dreaming about, they only show up every 3.5 years on average. He's essentially waiting for a bust that might not come for a decade. The second cost is the fear factor. Buying when everyone else is absolutely terrified sounds heroic in theory, but when you're actually in that moment, real humans tend to panic instead of buying.
And we've got the data to prove that humans panic. Research from Dalbar tracks how regular investors actually behave in the wild. In a recent year where the market returned about 25%, the average equity investor earned only 16.5%. They left more than 8 percentage points on the table in a single year. Why? Because during the scary stretches, they didn't buy the dip. We've all felt it, right? They froze. They pulled their money out right before the market ripped higher.
This quote just perfectly captures the dilemma. The buy the dip strategy asks for the most courage at the exact moment you have the least. A market crash isn't just a fun green light flashing, buy now. It's glaring red headlines on the news, your portfolio is down 40%, and there's a very loud voice in your head screaming at you to get out before it goes to zero. Cole's plan only works if you're a completely emotionless robot.
Which brings us to our final section. Consistency beats cleverness. Why automation is your best friend.
Let's check in on where our two investors land after 40 years. Cole, who was disciplined and genuinely smarter about markets than 90% of people, kept waiting. He missed the biggest bull runs of his lifetime, and when the crashes did finally happen, he didn't nail the timing like his fantasy required. Ultimately, his own cleverness completely ruined his returns. Carol, meanwhile, bought on the absolute worst days and the absolute best days with the exact same blank expression. By simply automating her investments, she relentlessly compounded her wealth because she never needed to be smart. She turned the scariest moments in market history into our best purchases without requiring a single ounce of courage.
And that brings us to the core message of this explainer. The trap was never really about stocks versus cash. The trap is believing that cleverness is the point, believing that there's some perfect, magical moment out there worth waiting for. The math keeps screaming that the perfect moment is right now. The only people who win long-term are the ones who are boring enough to just keep showing up, month after month, year after year.
So I want to leave you with this final provocative thought. The next time you find yourself holding back, waiting for a better entry point, ask yourself, how long are you willing to wait? Because the market definitely does not owe you a crash. And while you're sitting in cash waiting for the absolute perfect moment, the only thing compounding is the cost of waiting. Definitely something to chew on as you evaluate your own investment strategy. Thanks so much for joining me on this explainer, and I hope this completely changes how you view that cash sitting on the sidelines.